Well, it's that time of year again. We all dread it, but we can't avoid it. That's right, it's tax time. Hi, this is Tom Wheelwright, best-selling author of Tax-Free Wealth, CPA for many entrepreneurs and real estate investors, most notably Robert Kiyosaki, author of Rich Dad, Poor Dad. I'm here to make your life easier, hopefully save you some money and time by explaining how you can maximize your refund. Not just minimize your taxes, but maximize your refund. Today, I'm going to break down the top 5 things you can write off this year if you're a real estate investor. Now, the good news is you can be applying these tips if you own 2 properties, 5 properties, or 200 properties. I have over 40 years experience in real estate taxes, starting with Ernst & Young, including 3 years in the National Tax Office focused on real estate, 4 years with a Fortune 500 company in charge of their real estate business from a tax standpoint, 14 years as an adjunct professor in the Masters of Tax program at Arizona State University, and 30 years buying, building, selling CPA practices, and currently running a CPA franchise, the Wealthability franchise. Before we get into the actual top 5, I want to thank our sponsor for this episode, Steadily. Traditional insurance companies, and I know this as a real estate investor myself, make it painful to get a policy. With long lead times, lengthy paper forms, and speed that frankly rivals the DMV, don't modern landlords deserve better? With Steadily.com, you can get next day affordable landlord insurance in just a few clicks. From single family to short-term rentals, apartment buildings, and beyond, Steadily.com gets you the best coverage for the best price. Save serious time and money on your rental property insurance. Visit Steadily.com to get a commitment-free quote today. Now, let's get back to the show. Number 1 in our write-offs. Number 1 is mortgage interest. So if you are a homeowner for your own property, you get a mortgage interest deduction so long as your debt on your property is only $750,000, and so long as you itemize your deductions. And that's true whether it's interest on a flip or whether it's interest on a long-term investment. You get 100% of your interest deduction. So that means that if you're in a 30% tax bracket and you pay $10,000 of mortgage interest, you're getting $3,000 back from the government for paying mortgage interest. One thing to be sure of for all of these deductions is make sure you're keeping good records. There are several requirements to qualify for a deduction, but the most important one is good records. If the IRS, I like to say, if you have a pretend documentation, you get a pretend deduction. So make sure you keep those good records. Number 2 is property taxes. If you've got your own home that you're living in, you get a limited amount, right? You're limited to $10,000 of tax deductions. But if you own a rental property, or you're flipping, so you've got taxes on properties that you are turning, those taxes are 100% deductible. No limitation on taxes and interest when it's an investment property. Think of it this way. If you're doing something for yourself, buying a home for yourself, you get a limited deduction. If you're doing it for somebody else and providing homes for other people, then you get the maximum deduction. And write-off number 3. This is simply insurance. Insurance is a business deduction like any other deduction. No real limits on insurance. It can include PMI, rental property insurance, any kind of P&C insurance, not life insurance, the types of insurance you would get at Steadily.com. Don't forget, make sure you keep the documentation for your insurance as well. Now let's talk about depreciation. So depreciation is the king of the write-offs. I like to call it, in Chapter 7 of my book, Tax-Free Wealth, I call it the magic of depreciation. And it's particularly magic right now because for 2023, we have a write-off of 80% bonus depreciation. So it's an enormous write-off. So if you're going to do that, I'd recommend a cost segregation, because here's what you do. You get to write off, you might be able to write up as much as 20% of the cost of your property. Now, this is one deduction that only applies if you have a long-term rental. It does not apply to properties that you're going to flip. Okay, you have to have a long-term rental for this. But it is the real estate investor's secret weapon. What's great is your property can be going up in value and you still get these big deductions called depreciation. Number 5 is we don't literally think of a lot, but it's management and repairs. And I want to emphasize repairs. Certainly if you have a management company, their fees are deductible, just like any other business deduction. But repairs are special because when you look at your property, let's say you acquired a property during the year, you probably did some fix up on it. There are some accountants, unfortunately, some tax preparers who will just say, well, that's part of the cost of the building, right? And so now you're going to depreciate that as long as 27 and a half years for residential property. But the reality is a lot of what you do probably qualifies as a repair. And remember, repairs aren't recaptured either when you sell the property. So repairs are, if you think of depreciation as the magic number one, repairs are actually magic number two. And there's something that's often missed by accountants and tax preparers when they're doing a tax return. And it's worth spending a little more time and spending a little more money on your tax account if they understand repairs. Let me give you a bonus. So bonus is home office. People are often told, don't take the home office deduction. It is a red flag. If you do your tax return the right way and you set things up properly with a proper tax strategy, then you should never have an issue when it comes to your home office, because guess what? There's actually no place to report it if you do it the right way. So a home office is not just, we talking about what goes into the home office, but remember, a home office also makes that first trip out to see a property deductible and the last trip home deductible. So it also increases your automobile expense. So for most people, a home office will double their automobile deduction. So don't forget the home office. So there you have it. The top 5 tax write-offs you should be utilizing this tax season. Thanks so much for taking time to watch this video. I'm Tom Wheelwright, and you can visit us at wealthability.com. And in fact, we will give you a second opinion on last year's tax return. So not only can we talk about this year and going forward, but we can actually look at last year and see if there's something that, in fact, you could be doing differently. If you found this video helpful, like and subscribe to the BiggerPockets channel for more videos just like this, or BiggerPockets.com to check out all of the amazing tools BiggerPockets has for new investors.